Let's dive into the numbers with Mark Shmulik, lead internet analyst at Bernstein. Mark, thanks for being with us here this morning. Lyft and Uber have had a lot going for them the last couple of weeks, from policy success to the reopen potential of a vaccine, and now it seems investors are okay with these earnings. So how do we read them? Are they good earnings? Are they survival earnings?
Yeah, it's somewhere in between. To be honest, as an investor, the two biggest events that were concerning to the likes of Lyft were Prop 22 passing, so effectively being able to continue to conduct business as usual, and then the second around, vaccine news, and so possible light at the end of the tunnel that we're emerging. In the meantime, what Lyft showed us last night is they're controlling what they can control. They've been very diligent, very deliberate about cost takeout, about efficiency gains, and really about focusing on that EBITDA profitability target in 2021. And so a lot of, what management was telling us and a lot of the data points that they were sharing were very much focused around that drive towards that EBITDA profitability target. So, in my view, it's right in between, kind of the two goalposts, and they're really trying to control what they can control.
How much are they at a disadvantage from an investment perspective compared to Uber, with Uber's auxiliary businesses that were helpful to offset some of the pain during this period?
We still continue to prefer, Uber over Lyft, primarily because of that optionality. We still don't know the rate of recovery. There's still fundamental questions around whether, ride-sharing volumes ever return to previous levels. There's been talk of the migration out of metro markets, car ownership going up, and so we certainly prefer the Uber auxiliary business that has shown something like delivery, Eats in particular, within delivery, really growing and effectively driving the business through these trials where no one's getting into a car.
The amount of expenses, build out, advertising, what have we learned from Lyft on how they've used this period? Have they learned from this? Is there anything they can do about it? Or are they just going to be beholden to overall kind of broad macro shifts for future crises as well?
I think they've taken this opportunity to really review their cost base, really review the expenditure line items. You mentioned advertising. That's certainly a big one that's come up where, I think they've realized throwing coupons at something in the past, wasn't necessarily the business they wanted to build. And so they've taken significant cost out of the business. They even highlighted that their growth going forward here is going to focus on profitable ride growth rather than simply volume ride growth. That's a very different message that we're getting from management these past couple of months than, where we were at the start of the year. And so to me, it's certainly something I think investors want to hear, because everyone has always been asking, how profitable are these businesses? Are these fundamentally good businesses? We've already had some assurances that that's the case, but now we're seeing, management really kind of dig their heels in and really focus on building a business up from a lower cost base that's much more profitable from its unit economics.
One of the things you point out is Lyft's decline in revenue versus Uber's mobility decline, which is, I believe, the kind of normalized way to look at the ride-hailing components. What does that tell you, Mark, of the difference between those two rates?
Yeah, the rates aren't too far apart. I think it's about 4 or 5 percentage points in terms of the recovery difference. Lyft did highlight that their micro-mobility business was certainly, a nice tailwind this past quarter, which maybe that accounts for about, 2 percentage points or 200 bips of the difference. And certainly, in kind of the summer, fall months when folks are looking for alternate means, that was helpful. The other thing, that makes it very hard to kind of really compare the two against each other is, Uber's much more international, whereas, as we know, Lyft is very much U.S.-centric, with the bit in Canada. And so the way that they recover and the pace at which they recover is going to be very different, because a lot of this is truly dependent on, the pace of market reopenings. As we get into incremental lockdowns, we've seen it from the likes of Uber, where Hong Kong shuts down and all of a sudden, ride recovery volumes plummet again. And so I think there's, it's truly tough to compare them against each other, but we've certainly seen consistently, at least, focusing primarily on the U.S. recovery curve, it's trended just a bit faster than what we've seen from the international markets.
Now, Mark, does anything about the vaccine potential cause you to retool your own expectations? Right now, what's the view on what this stock can do, barring some big development as far as that reopening goes? I imagine if, tomorrow it turns out we've got the vaccine through, or let's say Pfizer's next update says we're all good. If you want it, you can get it by Q1 or insert date here. I imagine that might then cause another look at some of the status of these companies. Is that the case, or walk me through the way you're viewing this from your own rating perspective?
Yeah, I think even pre-vaccine, we had the recovery that, it's really kind of skewed towards the second half of 2021. And that's certainly, I think the time horizon that many investors have been looking at as a supposed plan to return to normal. What the vaccine news does is just gives incremental confidence to that timeline. And so certainly any incremental data points will cause the stock to continue to re-rate, as there's just more incremental confidence that either those timelines can be met or even accelerated slowly. So, on the reverse side is also true. So any kind of delays in potential, vaccine developments, rollouts, et cetera, would have the adverse effect, because that's really what, I believe has driven, Lyft's stock price over the past couple of weeks, which I think is up, 70+%. And it's really Prop 22 passing, which effectively suggests that their fundamental business can remain intact. And then further confidence that the recovery in the second half of 2021, remains on pace. And so, what I believe investors are looking for right now is operating leverage. And it's something even management called out on the call is, they're really at a point where they want to show that once the recovery occurs, they're going to be able to deliver that operating leverage and, inflecting towards EBITDA positive with much lower ride volume than what they needed in the past.